Banking Money and Debt, a legal accounting report for practitioners. 1. Professional vantage point and scope. You approach banking and consumer debt with the dual lens of accounting practice and legal reasoning, translating field experience with audits, real estate finance, and taxpayer representation into a structured analysis of how money, credit, and collection regimes operate in practice. You confine the discussion to banking, credit cards, debt, and money. Footnote. This section situates your expertise and narrows the inquiry to financial mechanics and their legal touchpoints. 2. What money is and why the definition matters. You treat money as a medium of exchange grounded in social agreement, not essence, and you illustrate that principle with examples such as commodity money and negotiable instruments. You distinguish legal tender from other instruments and emphasize that a means of payment is what transacting parties accept. Footnote. This section frames money as consensual exchange to prepare you for later analysis of notes and deposits. 3. Legal tender instruments and the character of notes. You examine Federal Reserve notes as obligations of the system and compare them to historical certificates and private scrip, noting that all are promises to pay with differing issuers and legal status. You underscore that a note is a promise to pay and that instruments circulate because law and practice recognize them. Footnote. This section links instrument form to legal function so you can evaluate liabilities and rights that follow. 4. Double entry accounting is the map of claims. You use the balance sheet and income statement to trace how assets, liabilities, equity, income, and expense record economic reality. You explain that every transaction has two entries and that bank statements reflect claims owed to or by the institution rather than simple safekeeping. Footnote. This section equips you to read banking entries without mistaking bookkeeping form for cash on hand. 5. Fractional reserves and deposit creation through lending. You review the textbook account that banks expand deposit balances when they extend credit and that reserve rules and supervision constrain rather than eliminate this creation. You caution that credit growth depends on capital regulation, liquidity, and borrower performance, not only reserve ratios. Footnote. This section describes how lending increases deposit balances while remaining bounded by prudential rules. 6. Loan origination mechanics from note to funding. You walk through a home purchase example in which a borrower signs a promissory note and security instrument receives a credit to a transaction account and pays a seller. You then show how scheduled payments retire principal, recognize interest as income, and reverse the lending entries. Footnote. This section demonstrates how your note gives rise to funding ledger credits and later income recognition. 7. Promissory notes under commercial law. You identify a note as a written promise to pay a monetary obligation that is not an order to pay and does not acknowledge the bank received a deposit of money from you. You warn against collapsing different legal categories and you urge precise drafting and document review before assuming terms. Footnote. This section clarifies what your signature creates and what it does not create under commercial doctrine. 8. Credit card statements and verification practices. You distinguish account statements that summarize charges, payments, and balances from proof of liability, and you explain how verification disputes work. You remind yourself to preserve records, request itemized proof, and track chain of title if an account is assigned. Footnote. This section translates routine card statements into evidence questions you can manage methodically. 9. Third-party collections and consumer protections. You note that third-party collectors must observe federal and state constraints and that you can demand validation and control contact methods in writing. You caution that you do not give legal advice and that you should consult licensed counsel before acting on statutory rights. Footnote. This section highlights that you may require fair practices while recognizing the need for qualified counsel. 10. Charge-offs, tax reporting, and economic substance. You explain that a creditor may treat an uncollectible balance as a charge-off for accounting purposes and that you may receive an information return for cancellation of indebtedness depending on facts and law. You warn that accounting treatment does not by itself determine your legal duties. Footnote. This section separates internal accounting entries from your potential tax and payment obligations. 11. Policy history and statutory landmarks. You place modern practice against the backdrop of the National Currency Act of the 19th century and the Federal Reserve Act of the early 20th century, and you emphasize that today's framework reflects subsequent legislation, regulation, and supervision. You avoid treating historical snapshots as current law without update. Footnote. This section anchors your analysis in statutory lineage while reminding you to check controlling law now. 12. Practical ethics and professional discipline. You commit to accuracy, candor, and record-keeping when you engage with banks, collectors, or agencies, and you decline tactics that would mislead or invite sanctions. You resolve to consult governing authority before relying on contested theories about money or enforcement. Footnote. This section closes with a professional ethic that prioritizes truthful process over expedient claims.